take care of U.S. taxes as it gets more and more complicated, I want to make sure that the process gets simpler as well at the same time, so that we can focus more on more value-added services rather than taking care of record keeping and things like that. Just a few online sites that you can find our company listed on is the U.S. Consulate, the IRS, and also Asia Expat as well. One thing I want to point out is I know that we're one of the few CPA service providers in Hong Kong that can actually electronically file tax returns. So if you ask other CPA firms in Hong Kong, I know that many of them cannot electronically file returns, so that's one of the benefits that I want to make sure that we can provide to our clients here as well. Now, imagine it's January 2017, right around the time of Chinese New Year. You're getting your 1099 statements, maybe your W-2s, you might get a Hong Kong IR 56B form, you might get a K1 here and there, and your bank statements, and you're thinking, okay, now what am I going to do with all these forms? And you just remembered that you had a big capital loss carry forward from 2016 that wasn't utilized, and there's this big, huge capital gain you're going to experience in 2017. And that's one of the surprises that I know that I hope that clients don't want to get into, and I don't want that phone call from a client as well to say that, Chris, I had this huge loss and I totally forgot about this because I didn't consider it, I didn't plan in 2016. So as advisors and as a CPA, I think one of the most important points I want to make to clients is planning is very important, and just making sure that we address all of the considerations throughout the year and work together, because preventing surprises is what people don't want. Some of the topics for tonight's discussion will include: do I need to file U.S. taxes and tax return deadlines, the foreign earned income exclusion and foreign tax credits, common sources of income, and kind of talking a little bit about Tariq's presentation. I want to kind of touch base there is how investment income is taxed. Very short presentation about Hong Kong tax and year-end planning. One thing I did want to point out before we begin is tonight's presentation is focused on a U.S. citizen green card holder market. So for those people that might be non-U.S. citizens or might be, let's say, Hong Kong or China citizens, it might not directly apply to you directly. However, I've done many presentations in the past that maybe focus on that. So if you want to talk to me after, I can talk with you about that later. Okay, first of all is, do you need to file taxes? Many people may have heard from a friend, you know what, I've heard that if I don't make more than $90,000 US, I might not need to file a tax return, or if I don't have this type of income, I might not need to file. However, to tell you the truth, most US citizens, no matter where they're living, probably do need to file a tax return. If their income exceeds what they call a standard deduction and personal exemption, which is about $10,000 US, you're required by law to file an income tax return, even if there may not be any tax that is due. The tax return filing still might be required. For many people, for most taxpayers overseas, their deadline becomes June 15th. Obviously, living in the US, the infamous deadline is April 15th. Everybody's just dreading this April 15th deadline. Getting their taxes done, making sure that all of their payments have been made before that big deadline. However, I guess the US government knows that it's a bit more complicated living overseas, and that's why they give an automatic 2-month extension to June 15th. One important change, this is actually a big change probably in 20 or 30 years. In 2016, this is the first year that the FBARs will actually be due on April 15th. FBARs are foreign bank account reporting. So this is actually one of the biggest highlights of taxes that I was excited about. But the benefit is, I guess previously, FBARs are always due June 30th, no extension available. and penalties can be quite significant for not filing or not complying with the FBARs. 2016 is the first year, so next year's tax filing season. FBARs will be due April 15th.
Oh, starting
For
next year.
2017.
So 2016 FBARs due in due in 2017.
Oh, okay.
Yes.
So we haven't, okay.
Yeah,
It
so,
doesn't
so,
seem like-
so that's why it's good you came tonight to know about this.
Oh, okay, it's good I came tonight.
But, and so if you don't take anything away, remember this.
Oh,
However, this is the first year that FBARs will have an extension available. So you can file a request for an automatic 6-month extension until October 15th, which would be very beneficial. So what an FBAR is, if some of you don't know, is U.S. citizens and green card holders are required by law to disclose their highest account balance of their foreign bank accounts. So meaning that if an individual has an account with HSBC of $50,000 US dollars, of Hang Seng Bank with $20,000, they're required by law to disclose to the U.S. government what the highest balance in each of those accounts were in every year, which can be quite significant, and a lot of people don't want to do it, but it's required by the law. Okay, another big change that happened about 2 to 3 years ago is FATCA. Many individuals have heard about FATCA, but may not be familiar with what it is. FATCA is a law that was actually enacted in 2011 that actually requires all foreign banks, for example, Hong Kong, HSBC, they're required by law to disclose to the U.S. government who is a U.S. Account holder and what their account balances are. So a lot of people feel that there's privacy issues there, and a lot of Americans in Hong Kong really hate FATCA. But unfortunately, the banks are starting to disclose more and more information to the U.S. government, and FATCA is actually happening in stages. I believe in 2016, it's one of the first years, I'm sure if you are U.S. citizens here, HSBC or Hang Seng Bank may have requested you to fill out a W-8, W-9, yeah, like either a W-9 form, or for non-US people asking for a W-8 BN. So they just want to identify who are US people and who is not US people, because they're going to begin to report back to US government who is a US person and who is not, and also certain other information like account balances, how much money might have been in an account, will slowly begin to be reported back to US. I believe in the future as well, income earned from the accounts will also be reported to the US government as well. So that's a big change. So does it affect you? Usually FATCA affects US citizens if their balance exceeds certain levels. If they're living in the US, if their foreign bank accounts are more than $50,000 US dollars, they may be required to report back what is the highest balances. However, for people living overseas, the balances, there's a little bit higher threshold, which is about $200,000 at the end of the year. So this is where it gets complicated. However, there are different levels where you may need to disclose and report back what the bank balances are. Something that many people may not be familiar with is that with FATCA, it's not just bank accounts, they also require, it's foreign financial assets. So for example, some individuals may have a bond or a debenture held in Hong Kong. Those are a type of financial instrument or financial asset as defined by the US government. So these are actually assets that would need to be disclosed as well.
MPF too? MPF accounts?
MPF accounts, yes. So MPF accounts or FBAR as well as FATCA all need to be disclosed. I wanted to finish up. So hopefully for any US people here, I think that hopefully they've been filing their returns, getting it all done. But for many people who I've known or I've clients who have came to me, I've had stories where I actually had a client who has never filed a US tax return for 30 years. They came to me, Chris, was filing my taxes when I was living in the States. I moved out about 30 years ago. I never filed a tax return since. These individuals are starting to worry, especially when the banks are asking them for information. So they start coming running because they are familiar with some of the penalties that can be imposed. For example, there's $10,000 penalties for non-disclosure of bank accounts. There might be penalties and interest for non-reporting of income tax returns. However, recently there is a few programs that have been available for taxpayers who have not filed returns recently. Some of them called is OVDP, Offshore Voluntary Disclosure Program, or another one is called the Streamline Program. So if you know any of those people, which I'm sure they're not announcing to all of their friends, but those people can probably come and talk to somebody like myself, maybe in private, because I think those people are not going to announce to their friends. I've never filed a return in 30 years. For most U.S. taxpayers, this is one of the greatest benefits that they're allowed as a U.S. Citizen. It's the foreign earned income exclusion. What it allows is, it allows U.S. taxpayers to exclude about $100,000 US of foreign earned income. Foreign earned income as in salaries, bonuses, allowances. So I think that's many people's misconception. They feel that if they're not earning $100,000 US, they're not going to be paying any U.S. tax, which is very true. They might not be paying any U.S. tax. However, they'll still be required to file a U.S. income tax return to show that they don't owe any tax. One thing to be careful about is it's foreign earned income. So most taxpayers would want to minimize the time of U.S. sourced income, so U.S. work days, because that would be U.S. sourced income subject to U.S. income tax as normally will be.
But if I understand right, even if it's a U.S. company that's paying you in your U.S. bank account, if it's for work that's overseas, it's still considered foreign source income, right?
Yes. So the key is will the services are performed.
Yeah.
So that's why, whenever I go through checklists and questionnaires each year, the one thing I ask all the clients is how many work days did you have in the U.S.? If an individual goes for a business trip out to the U.S., that's work days that you spend in the U.S. But on the other hand, if they're working and they work in Hong Kong, that's foreign earned income.
Excuse me, is the exclusion for foreign housing and the other exclusion above it mutually exclusive, or can you combine them? So can I declare $214,000 of housing income and real income before I have to pay tax?
So what it looks at as what is your potential, let's say an individual earns $100,000 US in salary, $100,000 addition in housing. Let's say a total compensation package is $200,000 US, broken out half salary, half housing. So the foreign earned income will allow you to exclude only $100,000, which is of your salary. But on top of that, you'll also be able to exclude any housing costs paid. So for Hong Kong as an expensive place to live, the exclusion is $114,000 US.
So the answer is yes, you can exclude.
Yeah. So on
up
top
to.
of yes. So yes. However, there is a floor amount that the U.S. assumes, which is about $15,000 to $16,000 US. So any housing costs that you pay up to $16,000 US will not be excluded. It's like a floor, meaning that the U.S. knows no matter where you're working in the world, you have to pay housing costs. So we're not going to give you a benefit for that first $16,000 of housing you pay. In order to meet the exclusion, there are two tests. You need to have a tax home in a foreign country, and either be a bona fide resident of a foreign country or be physically present in a foreign country for 330 full days. Many people get mixed up with the 330-day rule, and usually after the first year of living and working overseas, many taxpayers may actually be able to qualify under the bona fide residence test, which gives taxpayers a lot more flexibility. So they could spend potentially more time in the U.S., maybe a month month and a half if they really need to go back. But they would need to ensure that they're what they say a bona fide resident of, let's say, Hong Kong, which is that's a test that needs to be met. That test looks at all of the facts and circumstances of taxpayers. It's looking at where you have an employment contract, where you have bank accounts, where your rental agreement is held. Do you have any like club memberships in Hong Kong, where you're sending your kids to school? All of these facts will be looked at to determine if you are a bona fide resident of a foreign country or not. Because many times taxpayers may be working in Hong Kong, for example, but their wife and all of their children might still be in the US, going to school there, living in their property that they own there. So in that fact, it might be difficult to justify that this taxpayer might be a bona fide resident of Hong Kong. So these things are looked into to determine whether this test is met or not. So if that were the case, stay outside of the US for at least 330 days and you'll be fine. So the foreign earned income exclusion was one of the most common benefits that US taxpayers are allowed. This is one of the other, probably the second greatest benefit for many US taxpayers, is they're allowed a dollar for dollar credit against the US tax for any foreign taxes paid. The individual pays, who is a US citizen, is subject to Hong Kong tax if they're working in Hong Kong. They're also subject to US tax as a US citizen. However, they may be able to take a tax credit against the US tax if they pay Hong Kong tax, which is a good benefit. And it's a dollar for dollar credit. For example, when an individual files a US tax return, they get their tax bill, $40,000. But they've already paid $20,000 to Hong Kong already in Hong Kong tax. In that case, they'd be able to offset half of their US tax against, because they've already paid to Hong Kong already. So at the end of the day, they would be subject to $20,000 more in tax to the US government. One thing that many people are not familiar with is that the credit cannot be claimed for income that was excluded. Let's say, for example, an individual earns $150,000 of salary in 2016. They take the foreign earned income exclusion of $100,000. So at the end of the day, they're taxed on $50,000. They're paying tax on that amount. And so what that's saying is, let's say they paid $20,000 of tax to Hong Kong as well. The U.S. makes it clear that two-thirds of that $20,000 that you paid to Hong Kong, you cannot get a tax credit for that portion because you excluded the income, if that makes sense. So I think that they try to make it so that you can't double dip and get additional benefits in that way.
So you only get 1/3 of that.
So let's say that you paid $20,000 of Hong Kong taxes that year. 2/3 of that $20,000 will not, you will not get a benefit for that because that portion of your income was excluded. Just want to list out just some very common types of income that U.S. taxpayers need to be aware of. And one thing to keep in mind, I want to stress, is that U.S. taxpayers are unfortunately subject to U.S. tax on their worldwide income. So they're paying U.S. tax on their wages, interest, dividend income, capital gains and losses. If they own their own business, whether if it's in the U.S. or in Hong Kong or in China, for example, they will still be subject to U.S. tax on that amount. Rental income, if that rental property is in USA, in Texas, Florida, or even if they have a Hong Kong rental property, which many people may not have been familiar with as well, because I've had cases where taxpayers have came to me because I filed my taxes for the last 20 years, everything was okay, but I never knew I had to report my Hong Kong rental income. And so in that case, they were required to get their filings up to date. So those things just need to be kept in mind. Also, MPF, so foreign employer provided retirement contributions, unfortunately are also subject to U.S. income tax.
I missed that one.
So I think that's a common one, and the reason for that is
Meaning commonly missed?
um,
I didn't know that.
it's something that's commonly missed, especially for individuals that may prepare their own tax return, just because the a Hong Kong MPF or an ORSO plan may not be a U.S. qualified retirement plan.
Oh, yeah, yeah.
So as such, there's no tax usually deferral benefits in that case. One thing to keep in mind is all of these different categories of income have different tax rates and different tax treatments. I'm just going to touch base. What I want to stress tonight is how some of the investment income may be taxed in the U.S. This is the next slide. For this case, I'm gonna stand up and try to explain things in a bit more detail. So so for many U.S. taxpayers, they're subject to U.S. tax on all of their investment income as well. Many individuals have, let's say, a Hong Kong bank that's paying them interest. They invest in some U.S. NASDAQ or Dow Jones, and those companies are paying them dividends. Rental income, like Tariq mentioned, are also a type of investment income. And another one I want to go into more detail is capital gains and losses. One, as you can see here, I've just taken what some of the tax rates can be for a single individual. In the back, can you see what these numbers are way in the back? Okay. The highest income tax rate in the US right now is 39.6%. And that's a number that many people always consider, okay, US tax, I'm going to pay 39% of income tax on all of my income. But how the US tax system works is that an individual would only be paying US income tax at 39.6% if their taxable income is $400,000 US dollars or more. So this is like $3 million US dollars. So if their taxable income is more than $3 million US dollars, Hong Kong dollars, they might be in a 39.6% tax bracket. Keep in mind, this is only taxable income. So this is after your deductions, your exemptions, so this is after all of your considerations for how to reduce your taxes. Capital losses, for example, rental deductions, business losses. So that's why that number is very high. So I think that's one thing I just want to make clear is that many taxpayers are not going to be subject to tax on 39.6%. However, there are some that will be if their taxable income is in a much higher bracket. Let's take it for example, we have one individual making $110,000 US dollars of salary in Hong Kong. They're paying some housing costs, and they have, let's say, interest that they're earning from the bank, and also ordinary dividend income of about $10,000 US dollars of investment income. As you saw earlier, all of their salary will probably be excluded, so they're not going to pay any US income tax on their salary. However, because that they might be subject to US income tax at only, let's say, $9,000, they might be in a much lower tax bracket in that example. But so I think these are one things to consider. However, this example may not have been a very good one because if you exclude income, you're automatically placed in higher tax brackets. So this is what gets a bit more complicated. We're running through all these calculations every day, so we see it every day. That automatically the US says that if you excluded income, you're automatically put into a tax bracket. Let's say that you should have been put in, so you would have put, let's say, in the 28% tax bracket. So if you still have $10,000 US dollars of investment income, none of your salary is taxed. You're likely to be paying tax at maybe a 28% tax bracket. So given $10,000 US dollars of investment income, maybe that's a $2,800 tax bill that may be subject to. So I think how taxes are calculated can be quite complicated depending on the source and type of income, and this is why in good planning it can be very important to how to minimize taxes, and I'll talk a little bit more in the last slide about year planning. In Tariq's example about some of the REITs, is that the REITs would pay dividends, and a lot of these dividends would be categorized as usually ordinary income. So I think the benefit there is that they're paying out 95% of their basically income is being passed through to all of the to their shareholders. As such, that would be ordinary income to the individual. But if it's a significant investment, it's not significant dividends, I think that might be a good return. However, the tax rate, especially for an individual that has taxable income at a higher rate, you could see. So depending if an individual's taxable income at a low rate, tax might be 10%. Whereas if they're maybe in a $400,000 level, it might be somewhere closer to 33% tax bracket. So something to keep in mind. And the one last thing I want to just touch base upon very briefly is capital gains and losses, which some individuals are not exactly sure how they are calculated. Because in the US, there's a tax on capital gains, whereas in Hong Kong, there's no tax on capital gains. It's just a stamp duty that people pay if they buy and sell real estate here. For capital gains, remember that it's not realized until a sale of property. So if an individual never sells their property, they're not going to pay any tax on capital gains, which is fortunate. In addition, some people consider short-term versus long-term holdings. Long-term is greater than a year, and short-term is 1 year or less. The difference between short-term and long-term is the amount of tax that an individual might pay. For short-term, it's from 0 to 23, about 24%, and for long-term, it's basically up to almost 43%. I've actually changed these numbers because this number is the highest tax bracket, 39.6%, and this is usually 20%. What I factored in is something called the net investment income tax, which is new since 2013. It's an additional 3.8% surcharge. So for many individuals, if their what they call adjusted gross income is above 150 to 200,000 US dollars, they might be subject to an additional 3.8% net investment income tax, which is a tax that was part of Obamacare. So it's kind of to fund Obamacare as a new tax that was imposed in 2013.
Question. You mentioned earlier that Hong Kong has a stamp duty instead of capital gains tax. Is there any credit for that when you claim the capital gains tax in the US? Is there any way of getting the credit for the stamp duty paid in Hong Kong?
Usually, the answer to that question is I need to check. I'll check on that, but I would say sometime probably not, because what happens is you can take a tax credit, but oftentimes it's on income tax. You want to show it's income tax. So the stamp duty is not necessarily a tax on income.
Well, it sort of is, because it's a percentage on my whole proceeds from sale, and there'd be a way to attribute it to income.
Right. Something that can be looked into, I think, so that can be looked into. I would need to check on that, but my first answer would be probably not, but I'm sure there's ways that can be looked at. We can decide on that. But in this example, I want to just kind of run through how capital gains in the US are calculated. Let's say somebody bought 500 shares of Visa stock in 2012 for 22 US dollars per share. So that would be about 11,000 US dollars. In 2015, they sold these 500 shares at about 70 US dollars per share, which are about $35,000. Actually, Visa's trading about $80 right now. I checked online, just get an idea for there. But I want to just kind of give a realistic example here. So in this case, this individual would be selling their stock for 35,000 US dollars. Cost was 11,000, so the gain on the sale is 24,000 US dollars. Remember, capital gains, and this would be a long-term sale, would be taxed at probably no more than 15% if an individual is in a lower tax bracket. So I think one thing just to keep in mind there. Very few taxpayers are subject to the 20% long-term capital gains treatment, and the 3.8% more and more are being subject to that tax as well. for Hong Kong, just very briefly, this is one thing that many people ask. Okay, Hong Kong has a fiscal year from April through March every year. How do I take care of my U.S. taxes? U.S. is on a calendar January through December. This is one thing that important planning is needed to ensure that taxpayers maximize the benefit for foreign tax credit, for their exclusions, but I would say that foreign tax credit is the greatest benefit that needs to be considered here, because many times if the U.S. taxpayer pays their Hong Kong tax before December 31st, they will get the benefit in the current year rather than deferring the benefit to the next year. Salaries tax, usually in Hong Kong, standard rate of 15% or progressive rate from anywhere between 2 and 17% depending on the income amounts. And Hong Kong tax are a little bit simpler than doing U.S. taxes. However, things get
Understatement.
Two lines.
but it gets more complicated when there's things like stock options and housing allowance and things like that. So it's a bit more
It's only
complicated.
4 pages.
Okay, so I want to just briefly mention, so I get fortunate if you guys came today. These are some of the most important year-end planning strategies that I want to kind of just touch base upon that will be beneficial for most U.S. taxpayers. One of the basically tried and true suggestions always is deferring income and accelerating expenses. I think especially for companies, but as a usually a normal employee, for Hong Kong purposes, it's usually sometimes if there might be a bonus that might be paid out at the end of this year, it might be advantageous to defer that payment until January instead of getting it paid in December this year. So I think that's a method of, so instead of having to take care of it in 2016, maybe defer that amount to 2017. Accelerating expenses for most, it's very common for companies that they want to accelerate expenses, especially for year end. And in the US, there's many favorable tax benefits like accelerate depreciation and favorable tax deductions. But let's say that individual has a rental property, they want to purchase some new maybe washing machine or a dryer for the property that they want to do it for a few years. They might decide, okay, if they do it before December 31st, they might get they pay $1,000 US, they might get a 50% write-off on the washer and dryer instead of having to take it over a period of, let's say, 5 years, for example. One of the others is maximize the benefit of foreign earned income exclusion and foreign tax credit. So I think that's probably one of the greatest benefits for U.S. taxpayers living here. The housing cost exclusion is very high. Keep track of records for housing costs paid. Utilities are included, sometimes parking is included, electricity, gas, those types of utilities would also be included as housing deductions. And in that case, you're getting basically a dollar for dollar write-off to lower your taxable income there.
So there's a floor. What did you say the floor was?
It's about $16,000 US. About 16,000. So just over maybe
For a year.
Yes. So they assume that no matter where somebody's living in the world, they're going to be paying about $16,000 US of housing costs. So that there's no benefit for that first $16,000.
Yeah, I understand. It's above that.
Yes.
Unless you got a really good deal on your apartment here.
Well, I have for many years, and then I'm very frustrated. Never got that
Housing
deduction.
exclusion.
Yeah, I never
So-
got it because my rent was so low.
Okay. So any amounts in excess.
But now it's not.
Okay. And so keep track of the utility bills.
Yeah. But they're very lenient. I mean, they're very vague. But they never catch you, and they never just be reasonable. Put a reasonable figure in it, and it's okay.
So I think taxpayers can do that. However, in the case of the returns are audited, and there's no substantial
Oh, your
documentation,
taxes. What's the percent of chance you get audited? Like 1%?
that it changes every year. I haven't checked.
That's quite low. I think they have a threshold
Of how many returns
always
get audited.
what your income is, what percent gets audited. So if you're kind of the lower end, it's much, much lower, but if you're, coming out of the US a year or something, I'm sure it's much higher.
So I think that, but either way, at the end of the day, you want to make sure that you have the documentation. In the case the returns are audited, then there's no questions that are asked. Another is to reduce or eliminate the 3.8% investment income tax. This can be done by either planning when you receive your investment income. If an individual knows that they already have a lot of investment income in 2016, they might want to consider maybe waiting to 2017 to sell the other investment to spread out the income recognition. Because if they're gonna pay all of it in 2016 and have losses in 2017, losses in 2017 will serve no benefit. So just planning the timing of these recognitions of income. And utilizing stock losses, I think along those same lines. If an individual knows that they have significant tax losses from carry forward from 2 years ago, it's still $50,000 US. It's still going to be carried forward every year, and only $3,000 US will be able to offset other income, unless there's a significant capital gain. So if there's a $100,000 gain in 2016, half of that loss will be able to be utilized in the current year. One thing I just want to touch upon very briefly that many people often hear about but aren't familiar with is utilizing the gift tax exclusion. U.S. citizens are able to make unlimited gifts to any number of people of up to $14,000 US. So an individual can give money to their nephew, their niece, their mother, their father, up to $14,000 per year to any number of people before they have to report a gift. If they're making gifts of in excess of $14,000 per year, they would probably need to file a gift tax return, and it would reduce their lifetime gift tax exclusion or lifetime estate exclusion, which currently is about $5.4 million US. Is the lifetime or estate exclusion.
Well, what's the benefit for you as a giver, for your tax benefit?
You reduce your estate.
Reduce estate as in a taxable estate. An individual, if they have more than $5.4 million US when they pass away, they may be subject to estate tax when they die.
Well, they're heirs,
Or yes.
but they'll be dead.
So the beneficiaries, the trustees will be responsible to pay the tax.
The figure's $5 million out,
5.4 million estate tax.
And there was some issue about that might be going higher or lower, or it has to be
It's indexed, now it's
approved every year
indexed
or
for,
something.
it's going up slightly every year. So I believe that
Oh.
there's about 5.4 million in 2015, about 5.45 in 2016. So it is a small increase every year.
Oh,
In 1 year there was actually no estate tax. I believe in 2010
right.
there's none. But so the benefit there is sometimes taxpayers would want to put another person, if they're in a much higher tax bracket, they might give some property to an individual or to a family member who's in a lower tax bracket, and if they're earning income if they're paying tax in a much lower tax bracket, it will benefit both of them. They're still getting the same amount of money but paying a lot less tax. Just want to kind of finalize with this slide. So what next? I always recommend and tell clients, start getting your statements together. It's very easy to forget to download your HSBC statement from online. After a year and a half, it's no longer there. Individuals have had to when I filed late returns, have had to get 6 years of bank statements for 5 different accounts and pay $50 for each month. So these amounts can add up, and just the time, it takes sometimes a month just to get these statements, going to the bank 2 or 3 times. So just download them to PDF, keep these for your records, you'll need them. Stay organized. That always helps taxpayers and always helps getting your taxes done. And keep your bank statements, keep salary statements, and get ready for printing taxes for April 15 and also year-end planning for 2016. And one more reminder is that if individuals are making quarterly estimate tax payments, next fourth quarter is due January 15th of 2017, and next payment would be due on April 15th to basically take care of all of 2016. The IRS would charge penalties or interest if the taxes are not paid before April 15th. I'm going to just leave it at that. And if you have any questions for Tariq or myself, we'll be here for at least a good 15-20 more minutes. So I think please let us know, and thank you guys for attending tonight. Really appreciate all of your attendance. And want to ask you guys, maybe actually, if you guys can help, can you pass these out and make sure, if you guys don't mind, just giving some of these, I'll pass it up. Some of any feedback about tonight's presentation for Tariq and myself, and I'll be more than willing to share Tariq. If you guys just don't mind.
Also, these will be a good reminder that you have attended. I'm going to send an email with your name on it saying that you've attended. So if you need the certificate to show your department for the CE credit or anything, it's just going to be an email that says, you know, with our little header, your name, you attended this presentation, it was an hour.
Yeah, I think that. So we'll be around. So I think if you guys want to come talk to us in one-on-one.
And he has the key to my office if you want to speak to him in private about anything.
Is this still recording? Oh yeah, it's still recording.
Okay.
Yeah, you got it.